Hello. Welcome back to the No Reservations Podcast. Kasey Anton's Guide to Restaurant Success. That's me. And this is episode 54. So today I'm going to be chatting about why traditional accounting fails restaurants. And this is not going to be the first time, and it sure as heck is not going to be the last time that I'm going to talk about this. It is a very important topic, and it's a pretty common one because I see it almost every single day. So here's what happens. We are fortunate enough that we get a lot of referrals here at Spark. Many of them now come through the book, people who have heard about or read the book or listened to this podcast. Some come right through Profit First headquarters whenever a restaurant kind of comes into that sphere. They usually get rerouted over to us. So with that said, I'm probably having, 12 to 20 something conversations a month with restaurant owners across the US, some even in Canada. Oh, that reminds me, I have to reach out to somebody from there that I did not get back to. Oops. And of those, let's call it 20 conversations a month that I'm having, a good 18 or 19 are around this topic, meaning they probably already have a bookkeeper / accountant of some kind doing the books that are doing them absolutely no favors. So there is accounting, yes, and there's bookkeeping, and then there's restaurant accounting and bookkeeping, and they are very different. Now, the mechanics are the same. You balance debits and credits. Yeah, all the same. That's all GAAP accounting, GAAP standing for Generally Accepted Accounting Principles. That's what we follow here in the US. That's how we all stay on the same page when it comes to filing our taxes. So yeah, all the mechanics are the same. The balances, balancing the books, the same. But how we structure the books for a restaurant, very, very, very different from how you do almost any other business. And so here's what we see happening all the time. And by all the time, I mean a good 95+% of the time, is that a restaurant might be working with a really good accountant or bookkeeper or both. And they're covering the compliance angle of the reason to hire an accountant or bookkeeper, which is good. To me, that should just be a given. But it's good. So it's compliance. It means that, they're following the letter of the law when it comes to accounting so that they can file their taxes and everybody can be above board with the IRS and state agencies. Get it? Got it. Good. That's a given. What is missing is the design and structure of the financials so that they are actually become the tools that any business owner, but most especially a restaurant owner, needs in order to run a successful business. So that's what we're going to talk about today. What to look out for, what it looks like, et cetera, et cetera. So here we go. I'm going to be looking at some notes that I was writing earlier so I don't get off track, because I could really go off track with this. Because again, this is something that I spend a majority of my time talking about with business owners, and in podcasts and things like that. So I'm going to try and keep it as succinct as I possibly can for this episode. All right. Now, have you ever looked at your P&L and thought, all right, well, it looks good. We were busy. Sales were high. It even shows a profit, but where'd all the money go? Get that one a lot. Or if I'm not getting that one, more often with restaurants, I'm getting, I don't know, we just can't make money. I'm getting that. But I don't know. We're busy. Why are we not making money? That's something that I diagnose all the time. But if you're not working with us or a firm like us, if your accountant or your bookkeeper is telling you that your restaurant made money 3 months after the fact, or that you nailed your labor, your prime costs 3 months after the fact, no. That's history. You don't need a historian for your business. Historians are great in academia. We don't need it in running a restaurant. You need a financial operating system. Every business needs it. A restaurant more than most, because our margins are so thin in restaurants. You need a financial operating system. That is what my book is about. I'm not even here to plug my book because most likely if you're here, you probably already bought it and read it anyway. But that's kind of the crux of it. If you have a financial operating system in place, it's going to be hard to go wrong. And if you do go wrong, or if the business goes wrong, you know immediately. All right. So I got a few points here. I think there's 7 or 8 of them. So let's go point number 1. Traditional accounting, so that's GAAP, GAAP, standing for Generally Accepted Accounting Principles. That's like an IRS term. So traditional accounting is designed for taxes. It's not designed for running a restaurant. So most accountants, traditional accountants and bookkeepers, are trying to produce financial statements. So that's your P&L, your profit and loss, also called an income statement, and your balance sheet. And they use those so they can file your tax returns and that you can stay compliant. And that's important. It's also a given. Here's what restaurant owners need. They need to know if they can make payroll on Friday. They need to know if their labor is running too high immediately. They need to know if their food cost is escalating and why that happened. They need to know which menu items are making them money and which are probably costing them money or not selling at all. And they need to know how much they can pay the owners. Not too much, not too little, just right. Those are very, very, very different questions than tax compliance. Compliance keeps you out of trouble, which is important. But it's financial management. It's your financial operating system that makes you money. Also very different. Both important. I'd say making you money. I'd almost say it's more important, but it's not. Because compliance is important, but it's a given. You shouldn't even have to think about it. It's a given. All right, point number 2. Monthly financials arrive far too late. Oh God, this one kills me. And I hear this all the time. If you're receiving your April financials in June, you already made June decisions based on April information. Not helpful. Restaurants move too fast. Restaurants are living, breathing things. They don't stop. You need weekly flash reports or dashboards, whatever you want to call them. You need daily sales trends. You need to know your prime costs, front of mind, tip of your fingers. You should always know what your prime costs are, and you need to know what your cash flow is so that you know if you can pay the meals tax, the sales tax, if you can make payroll, if you can pay the rent. That's all cash flow strategy, and it should be in your operating system. You should know it. You shouldn't have to memorize it, and you shouldn't have to be the one to create it. You should have someone create it for you, and you should know it. Not waiting 45 to 60 days and being like, oh man, labor's high. Oh yeah, I'm running 60 days on my landlord right now. Not necessary. Not with an operating system in place. All right, point number 3. Standard bookkeeping tells you what happened, not why, and not what's currently happening. So if your P&L says that your food cost was 82 grand, okay, great. What does that mean? Is 82 good? Is 82 bad? What does it mean? Did it tell me if I had any theft? If some of cases of meat are walking out the back door? Was it waste? Did shit get thrown away? Did I order well? Did I not order well? Did I under order? How's my menu pricing? Are these prices right? Are they too much, too little? How's my portion control doing? Is the staff prepping appropriately? As a matter of fact, I just recorded on our MacDaddy monthly membership. And if you don't know about it and you like these podcasts, it's just like these, but more so. And they're actual, it's like slideshow presentations that I do. Very similar to the podcast in terms of I try and keep them like under 30 minutes. But you'll also see slides that I created. And we usually have takeaways, like downloads you can use, like tools you can actually use. And so today, before this, I actually recorded, it's called Monthly Mac Daddy Hour, number 24, I think it was. And it was all about back of the house, kitchen operations and organization. It's a lot of good stuff in there, if I say so myself, which I do. And a lot of it is about how important portion control is and how easy it really can be to do. So take a look at that. Have your vendor prices gone up? Are you making mistakes on your inventory? Traditional bookkeeping cannot answer any of those, but your restaurant accounting can. Your restaurant operating system, your financial operating system can answer those. All right, number 4. A generic chart of accounts, like the one that comes with QuickBooks, creates garbage reports. That might be a little harsh, but not really. It's pretty accurate. They're not the reports, unless you're like a whiz at reading financial statements. You can use them. It'll just take you longer. So we have developed a very specific chart of accounts for restaurants. We offer it for free. It's a download on our tools page. It's a good start. I mean, you can certainly, every restaurant is different. And when we work with clients, we tweak and customize it, but we start with that template. Because most restaurant books might have meals, supplies, miscellaneous, and like cost of goods. Rent, utilities, labor all over the place. It's useless. You have to literally scan up and down and sideways over the page to get the information that you want. That's not necessary. We want to structure your financials so they tell the story to you in a way that you can quickly and easily absorb what that story is. So, for example, when we use our chart of accounts, we have food, liquor, wine, beer, NA beverage sales at the top, and the mirrored cost of goods, food purchases, liquor purchases, beer purchases, wine purchases at the bottom. Not on the bottom, but under the cost of goods. So that in QuickBooks, we create custom reports just for food, just for beer, just for liquor, just for wine, and just for NA beverage. Then we have paper goods, because let's face it, to-go is pretty popular these days. We want to keep track of that. Kitchen smallwares, cleaning crews, cleaning supplies. These are things that can get out of whack quickly, so we separate those out. Repairs and maintenance in the building, repairs and maintenance in equipment. Really good to have that number, because sometimes we need that to say, hey, should we buy the new lowboy or can we just get it fixed? Financial data is going to tell you the answer to that without you trying to figure it out based off of intuition or a bank balance, which is another horrible thing. Merchant fees, third-party delivery fees, we want to keep those in line at all times. Music licensing, maybe. Music and entertainment, maybe, depending on your business. We want to keep those separate. So when reports reflect how restaurants actually operate, that's the chart of accounts that we design and then we customize per client that works with us. We want the report to reflect how your restaurant actually runs, because then you'll make better decisions and you'll actually like looking at them because they'll speak to you. You'll get it. All right, point number 5. Restaurants live and die by prime costs. They do. That's why they're up at the top. You live and die by it. Those are the 2 biggest factors in a restaurant. Prime costs are food and beverage, labor. You those got to stay in line, and then everything else is how you run the business. I get it, but if those are offline, nothing else really matters. So traditional accountants obsess over net income, sales, and then expenses are whatever they are. This is traditional accounting speaking. And then profit is taxable event, but let's hope you have some. For me, that's not small business accounting at all, but it's certainly not restaurant accounting. Restaurant operators, you should be obsessing over your prime costs, which are, like I said, your food and beverage costs, and then separate those out. Food, liquor, wine, beer, whatever it is you're selling, and then your labor costs. Those are the 2 things you should obsess over daily. And then the next one, if those are in line and you're still not making money, then we're probably looking at your occupancy costs. And here's the thing about that, because I do see this every once in a while. Thank God not that often, once in a while. If you got yourself into a lease where your occupancy, so occupancy could be, it is rent and everything associated with it. Rent, utilities, real estate taxes, whatever you pay for the shell of the building, pest control, water, all the things associated with the building, right? It could be internet, phone. That's occupancy costs. If that is running more than 10% of your sales, you could be in trouble. It's not a given, but you could be. If it's closer to above 15% of your sales, you're probably in trouble. But here's the thing. If that's the case, if you're nailing your prime cost, but your occupancy is over 15 and you're not making money, then we pretty much know that the only fix is going to be sales, which is rarely ever the answer. It is almost never the answer in the I'm thousands at this point, but in the hundreds every month of restaurants I look at, let's say, look at hundreds, maybe over a couple months it's hundreds, but it's at least 100 a month, if not more, that I look at. Sales is probably the issue in 1 out of 100. It's never about sales. It's usually your prime cost, or once in a while, it's going to be about your occupancy. And if that's the case and your prime costs are good, then it is 100% about sales. And that's a very different conversation than where can we save money? Because it's not about saving money at that point. It's about you need to drive a certain amount of revenue every single week, every single month in order to afford the rent in that building. Okay. All right. Point number 6. Cash and profit are not the same thing. That's probably obvious. If not, I'll say it again. Cash and profit are not the same thing. Not at all. Saying I made 80 grand last month is not the same as saying I sold $80,000 worth of stuff last month, or I paid myself $80,000 last month. It's very, 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 very different. So your profit, maybe your profit was 80,000, which would be amazing, first of all, because that would probably be, you'd have to be doing, $800,000 to $1 million a month in sales in order to get an $80,000 profit. So if you are, congrats, it's great. But that could be profit on a P&L, also known as net income, right? That could be $80,000 profit. However, if you have debt, if you make debt payments of any kind, that is coming off that 80 grand, because that is how you service debt. It's not an expense. Only the interest portion is. Whatever you pay in your interest rate, that's an expense. The actual payment, that comes out of profit. Owner's draws and owner's distributions, partner draws, partner distributions, profit distributions to investors, whatever, all comes out of profit. So if you happen to have a P&L that reads an $80,000 bottom line, whether it's year to date or monthly or whatever, just say it says your net income, your profit is 80,000. But then you look and you add up all of your debt payments and any monies paid to employers, and to owners that are not on payroll itself, or investors or whatnot, subtract those payments from that 80, and that would actually be what your true cash profit is. So it's very different. And in this case, and what I see more often than I don't see, is that while it may show that you made $80,000, let's say for the first 6 months of 2026, if you had debt payments of $126,000, well, then you're really at a loss of $46,000. And this is what I see most of. And that's what doesn't click with a lot of operators. And that's what we help you understand. Because again, what's inside that profit number are loan payments, equipment purchases, if they're on the balance sheet, owner's draws, owner's taxes, even inventory, credit card timing, meaning maybe your credit card deposits haven't hit from the weekend yet. That could be all affecting what profit is. So profit is not cash. Okay, point number 7. Restaurants need operational accounting, not traditional accounting. Your accounting, the accounting system that you use, like I keep calling it, your restaurant financial operations system that you should be using should answer these questions. Should I stay open on Mondays? Can I afford to hire another manager, part-time or full-time, or another chef? Should I raise my prices? Should I open a second location? Should I buy that oven or get it fixed? Those aren't tax questions. Those are operational questions, which is why tax compliance is one thing and should just be a given and shouldn't even have to think about it. We want our financials to answer operational questions, and they should. And for our clients, they do. All right, and then point number 8, this is the last point that I'm going to make. The biggest mistake is looking backwards. It's important to do so, but only to a point. We want current data. We want the information now to make the right decisions. What I find is that many owners spend or think it's appropriate to spend hours reviewing last month's, last year's, last quarter's P&L. But instead, you want to ask, what decisions does this current report help me make this week? I get the historian point of view, fine. But what's it going to help me to do differently this week? If the answer is none, your accounting system is broken. All right, here's a client story for you, a quick little client story. We worked with a restaurant whose books actually looked really clean. Like I couldn't complain. Their CPA or their accountant, whoever they were using, thought that everything was great. And it was. Like it was clean and neat. But it didn't give them anything they needed. It was like sales, COGS, expenses. But once we separated out their beer, their wine, their food, their liquor, their labor, vendor spending, cash flow, we discovered they were losing money every single weekend because of their labor scheduling. Now, they thought in their heads, because weekends were busier, that it was okay to have a full house of staff because they were going to streamline it during the week when it was slower. But when we redid the financials and reviewed them and the way that we set them up differently, it showed us like, no. Running a 52 or 53% labor cost on the weekends is going to kill you. If you're going to run a 40+% during the week because it's slower or whatever, then you need to run under 30 on the weekend. So those two together can be somewhere in the 30s, hopefully, for labor. They were doing it in reverse because their reports weren't showing them any differently. Nothing was wrong with the actual bookkeeping, balancing, reconciling itself, but everything was wrong with the information it was giving them. So again, the debits, the credits, the recs, all correct. The information to be determined was wrong. All right, here's our recap. Traditional bookkeeping and accounting gives you reports. Restaurant accounting gives you decisions, gives you valuable data. Spark focuses, as you know, my book focuses on building a financial operating system for your business. It's not just about reconciling bank accounts. So quick fire, here we go. Signs your current accounting system isn't working for you. 1, you don't know your food costs immediately. 2, you only look at reports during tax season or maybe when they get sent to you throughout the year once in a while. 3, your CPA never asks you about operational questions, or your current bookkeeper or your accountant. They're not asking you about operations. It's a big red flag. 4, your chart of accounts is full of miscellaneous or just random shit. So 4, 5, you can't explain why cash is disappearing. It shows they made money. Where'd it go? You should know that immediately. 6, you wait weeks for financials. Ugh, I hate that. 7, you don't know your prime costs. 8, every month feels like a surprise. Maybe not even a good one. If you checked off 2, 3, or more of these, it's time to change your system, and it's not that hard to do. Couple ways you can do it. 1, we put together a free restaurant accounting essentials cheat sheet that goes with this podcast that you can download. It walks you through the key pieces that every single restaurant owner should have in place. You can do it themselves. You can give it to your current bookkeeper and accountant if you love them and say, hey, do this. Very easy. They can do it. If today's episode made you realize your accounting system isn't giving you the answers that you need at the tips of your fingers, download it and use it as a scorecard against your own business. Also, we have created a course called the RACC. It stands for Restaurant Accountant Certification Course. So once again, if you love doing the books yourself, don't recommend it. But if you love doing them, if you have a bookkeeper that you love, an accountant that you love, but you know they could do better, just have them take the course. Bookkeeping records history. It's about being a historian. Restaurant accounting should help you change the future. It helps you make decisions. That's the distinction. That's why you need a good restaurant bookkeeper. And that is a wrap on episode 54. Went way over. Oh, no, I didn't. It's only about 24 and a half minutes. I hope you enjoyed. As always, please, please, please share, like, comment on this. It helps spread the word a little bit more. And then reach out to me if you have any questions. All right. Have a great one. Bye.